Welcome back. It's time for business now. For that, I'm joined by Owen Fairclough. Hello, Owen. Now, we're going to talk a bit more about Facebook. We were talking a lot about this company, obviously, this week. It's turning into a pretty bad week, though, for it. Its flotation is now under investigation by financial watchdogs.
Yeah, I think that's something of an understatement, Claire. Of course, it was the biggest IPO ever for Facebook, but this company's credibility is fast in danger of unravelling. The share price took another huge pounding in trading on Tuesday, ending the day 9% down. That means it's now lost billions from its initial market value of over $100 billion. And what went wrong with the Facebook flotation is now the subject of a financial watchdog inquiry.
Expectations too great even for Facebook. With over 900 million users, the world's largest social network launched its highly anticipated IPO last week, but failed to meet market hopes.
Everybody's been told, look, just wait till May 18th. Facebook is going to pop. Everyone will get very excited about the internet.
But instead of pop, investors got a dud. They say there wasn't enough demand for the 421 million share IPO, and before long, Facebook shares fell 18% to $31, and the company's valuation lost some $16 billion. Some blame Morgan Stanley, the lead underwriter, for allowing Facebook to increase expectations despite revising its own forecasts on revenue growth.
There was this hype that was created, all this demand, and people wanted it. They were going to move the price up, so they go to the insiders to say, listen, if we move the price up, you can sell more stock.
Now, Massachusetts authorities are investigating whether Morgan Stanley mishandled its promotion of the shares. The question is whether its analysts took the highly unusual step of scaling down their forecasts and publishing this information to clients ahead of Facebook's flotation.
Morgan Stanley is not only a respected company, but it was the underwriter of the shares. So it creates some confusion. There'll be some institutional investors, savvy investors that'll go from being optimistic about Facebook, buying Facebook, to turning around to selling it short.
Adding to the chaos, one investor is suing NASDAQ, claiming software glitches delayed the IPO's debut and caused losses. But there were some winners. Facebook CEO Mark Zuckerberg managed to sell his stock close to the original IPO price. He turned his 30 million shares into just over $1 billion.
So some pretty canny moves, Claire, by Mark Zuckerberg. At least he managed to win out in this whole flotation. Just worth noting, we have heard from Morgan Stanley, the lead underwriters in that Facebook IPO, saying they did everything by the book. Of course, a lot of that and that statement will be subject now to that inquiry that's been launched on Wall Street into what happened with Facebook. Let's take a look at the markets. Facebook left Wall Street very flat in trading on Tuesday. The Asian markets have picked up on the same theme. In fact, the Nikkei is now trading down more than 2%, briefly dropped below 8,600 points. That all-important threshold of 10,000 points hasn't been reached for some weeks now. You can see the picture across the board there is pretty weak. And of course, we've got that EU summit later this Wednesday with EU leaders once again locking horns over the growth versus austerity argument.
All right, let's now take a look at some more company headlines, starting with Dell, whose shares have dropped 12% after its latest results. The US computer maker's first quarter profits missed expectations to fall by more than 30% to $635 million. Sales to consumers were the biggest loser, down 12%, while business sales suffered a modest 3% decline. Dell is forecasting weak results for the next quarter.
Crédit Agricole has become the latest target for shareholder anger. Attendees at the French bank's annual meeting in Paris tore into the board over the 14.7 billion euro losses that have driven the company's share price down by 70% over the last year. The firm told shareholders it's now asking Greek authorities for access to an emergency liquidity fund. That's in order to prop up its loss-making Greek subsidiary Emporiki.
And Formula One's impending flotation is gathering pace after 3 investment groups bought a 21% stake in the motor racing sport. Waddell and Reed, BlackRock and Norway's Norges Bank spent a combined $1.6 billion buying stock from F1's majority owners, CBC Capital. The deal sets a value of around $7.5 billion ahead of Formula One's flotation on the Singapore Stock Exchange next month.
Now, think bling, think Prada, think luxury jeweler Graf, and you kind of get the picture. Hong Kong is fast becoming the destination for luxury brands to float on the stock exchange, and that's behind Nissan's latest venture. The Japanese car maker wants to get that little bit closer to a fast-growing market and bring with it its own slice of prestige.
A key regional investment, but also a symptom of Europe's economic crisis. Nissan sales have rebounded after production was hit by last year's earthquake and tsunami in Japan. Now it's chosen Hong Kong for the headquarters of its luxury brand Infiniti. The reasoning is simple: better growth prospects in China.
The Chinese consumers are looking at brands, but they're also looking at products. So if you come with a great product, with a great concept, with a great technology, you have a much better chance in China to make a breakthrough in the market.
But the move also takes account of the economic slowdown elsewhere. In February alone, Nissan sold more than twice the number of cars in China than in Europe, and sales were up by more than 50%.
We think that Europe is going to be a struggle for the next 3 years, that at best the market is going to be stable during the next 3 years. That's our most optimistic scenario.
In China, it's luxury brands that are booming, a trend Nissan is hoping to capitalize on after troubled times in the motor industry.
Now, Owen, I lived in Australia for a few years, and something that a lot of my Facebook friends have been talking about is this OECD finding. Australia apparently #1 best country in the world.
And the happiest in the world, Claire. It's official, that's right. It has beaten Norway, traditionally one of the highest scorers in any quality of life survey, to reclaim the #1 spot. Only marginally ahead of Norway and the US. And perhaps not a massive surprise, as you say, if you've lived there, you know it. Australia, while the rest of the world has been going through an unprecedented crisis, has been quietly booming over the last few years, sailed through the 2008 crash. It does things now that most countries can only dream of in terms of growth. It's had solid growth. Its currency's been flying. It's seen as a great investment for things like minerals. But as you say, the OECD think it's the happiest place in the world to live. It does look good, doesn't it? We've got some tourist board shots there of all the best of Australia. Unemployment rate is just under 5%. That's compared to a Eurozone unemployment rate of 11% and rising. The Australians, it seems, can do no wrong right now. If you do think Australia is the greatest place, Claire thinks it's pretty good. I'd be interested to know, wherever you are, do you think Australia is the happiest place on the planet? If you do, or if you don't, do drop me a line. Please don't sledge me about the English cricket team in Australia. But do let me know whether you think Australia really is the happiest place in the world right now.
I don't know about the happiest, but it certainly is very beautiful, and I really enjoyed my time here. But I'm very happy to be back here in France. Thank you very much, Owen. That's it for business. Do stay tuned to France 24. Stuart Norval will have all the latest headlines coming up in just a few minutes' time. Don't go away.